technology, diversity, wine, the redwoods, and everything in between. Welcome to the Northern California Bay Area, and one show takes you inside the real estate that makes it all happen. This is By the Bay.
Hey everyone, welcome back to By the Bay. I'm your host, Dan Anchetta, and I wanted to just say thanks for being here for another episode. And please do make sure to like and subscribe on Apple Podcasts, Spotify, and YouTube, wherever you're taking this podcast in. Today, my guest is Chad Fillinger from Fillinger Insurance here in Petaluma, California. And actually, you're here in the same building as we are, which is very convenient for you, shortest commute in history to be on the podcast. So thanks for being here, Chad.
Absolutely.
And tell us about Fillinger Insurance and what you guys do in the community.
Yeah, so we're a family-run business.
Started by your dad, right?
It did, yeah. In 1989, he launched and was doing health, life, disability, long-term care products. He never really, I mean, he was licensed, but he wasn't doing any of the property and casualty, which is your home and auto and business insurance stuff. And then 2011, 12, I joined kind of with him and another property and casualty business with the efforts that we might be purchasing that agency after a 2-year window. That didn't work. I left. I started basically the second half of Fillinger Insurance, which is the property and casualty side of what he didn't do. So I've been doing that since 14, and we've just grown basically, very organically. I mean, it was very, very small. It's from scratch. So to be where we're at today, it's great. We have a really, really nice setup with a really nice staff, and we've done well so far. So really appreciative.
You're one of our, our preferred insurance providers when our clients are looking for homeowners insurance. And so we'll, you're on our list, and we send our folks to talk to you because you great customer service and timely response and that sort of thing. But going beyond, being nice and that sort of thing, talk to me about so the focus of the podcast is homeownership and real estate in the Bay Area.
Yep.
And I think, obviously California has had a bunch of different challenges, a number that you have named off, but talk to me about some best practices that a home buyer, specifically like a first-time home buyer, when it comes to getting property insurance, what are some of the things that they need to be thinking about?
I mean, the first thing is it's almost, and this is tough because as a first-time home buyer or even a home buyer, you're not thinking insurance. Part of that responsibility needs to be with the realtor, hey, educating them, oh, you like this house, or this is something you'd consider putting an offer in on. You want to find out what's it look like from an insurance standpoint. And what I mean by that is are there additional liabilities or exposures? Are we in a standard area? Are we in a high fire danger area? Because those numbers can, I won't say ruin. I mean, you would know more, but they can affect your.
It changes the math.
It does. I mean, if you pencil in, which is how it used to be done pretty much, and still I'm sure a practice that a lot of people do is where, it's $1,800 a year, $150. That sounds about right? And then all of a sudden you mock up this loan, and now all of a sudden the insurance agent comes back to you and says, it's $7,000, right? And you were $1,800.
Yeah.
It's a big difference. So finding out if you're eligible or where you sit is the biggest component, because that determines, can you still afford this house?
So what are the factors? So, we do this all day, every day.
Yep.
So we kind of know roughly where these homes are and what associated risks there are. But what are the factors that a home buyer should be looking at or thinking about when they're looking at a house? This is going to be more expensive to insure.
Yeah. Once you start getting into the county land, if you're in the county of, outside city limits, you can probably expect to see your rates go, a higher rate. When you're in the middle of town, when you're in subdivisions like that, you're not going to be affected as much. Now, Santa Rosa, I know this is Bay Area, so we're going to talk about Santa Rosa, where the fires were in 2017. Now there's pockets in Santa Rosa, you up to Fountain Grove, which is up. I mean, that's just now with State Farm leaving,
that's relatively breaking news.
Yeah, as of Saturday.
Right.
And we don't write with State Farm, but we work with them, and it's going to be a big
They're right.
issue.
They're not writing any new policies.
Nothing
in the state of California.
Nothing. As of last Saturday, though, what is that? The 26th, 25th?
That's unbelievable. I mean, that's a major player.
Huge. The biggest home insurance writer in I think the United States.
So what does that do? What does that do in terms of the market and the premiums that a home buyer is going to pay?
Well, totally. I mean, and going back to, I'm sorry, I didn't want to go too far off subject. I do want to talk about the State Farm thing, but I do want to finish your comment. But I think as a home buyer, it's important to basically understand what you're getting into. Just know ahead of time, because then you start getting emotionally invested, right? Like, I really like this house. I did the walkthrough. What are it's going to take? And then, oh, wait, what? Insurance is going to be how much? Like, and the components that go into it used to be, and I say used to, and that was like 6-7 years ago, where if you had a responding fire department within 6 miles and a fire hydrant within 1,000 feet, that lowered your protection class. We go by, it's called protection classes. And a 1 would be San Francisco, given its proximity and how far, close to, and a 10 might be, you live up in the hills and there's just, it's 20 minutes for a fire truck to get there.
Right.
So now they're kind of throwing that model out and they're looking at fire line scores, was what it's called. So a fire line score starts at 0 and goes up. And those can be dictated by topography, density, rate of spread, exposure, potential for catastrophic loss. So it's a model that they've built that goes into, and they look at that now. So you might say, oh, my protection class is a 4. It's like, yeah, that's great, but what's your fire line score? Because that's what they're looking at. And these models are using scientists, they're using the technology to look at this and say, because from an insurance company standpoint, I mean, these losses they're taking, they're billions. They're not like, oh, I had a $5 million loss. They're billions. And they have to do what they can to prevent that or see like forecasts, what it was. I mean, Tahoe.
Like properly price it, right? Because there's a. Right.
Totally. Because remember Tahoe burned, 2 years ago?
Yeah.
And I had never in 10 years, I had not had a fire up in there, but it was very difficult to ride up there. And then bam, they were projecting, they were projecting. And what happened? It hit. So it's just important to understand when you start to get outside of city limits, like you're going to lessen the opportunities to write with certain carriers.
So I guess if you're out of a subdivision, out of city limits in a county property, right? That is the number one thing to say, okay, we're getting more expensive. Insurance is getting more expensive from here.
Yeah.
So what other factors? So sometimes depending on who our clients are writing or getting insurance from, sometimes they get like a packet of stuff they've got to fill out. When was the roof replaced? When did this happen? When did this happen?
Yeah.
And other times it's like, what's the address? Here's a number. Why is there such a difference? Is it like a technology thing or is it like what's
age of house? Okay. So let's just say you have a house that was built 1990 or later. Okay. So now you have this 30-year window where it's been from time built to time purchase. And things are still in working order. Your heater's still probably pretty good. Your roof is probably still intact. Those things. You have a house from 1950. They want to know that they've replaced the heating system, that the electrical is not a knob and tube, or that they've got fuses. And again, it's all risk. So that's why you might get those additional questions just dictated simply on the year built.
Okay. So that's not a every client thing. That's like specifically because of the age of the home.
Correct. They want to know that it's been upgraded. Okay. Because if you have knob and tube or fuses, which insurance companies think are highly dangerous.
Sure.
Electricians might argue differently, but they're going to look at that and go, okay, well, that's more risk than we want to take on. There's likely that there's going to be something happen given that hasn't had, I mean, just an off note here that I was talking to a realtor the other day and I said, one thing you have to educate yourself on is you have to flip up the circuit breaker panel. He's like, well, why would I want to do that? And he wasn't saying it in a rude way. It was just like, well, what for? I go, because right now there are a few insurance carriers and they're more jumping on board that are saying that there's this circuit breaker box that was built in the 70s and 80s called Federal Stab Lock or a Zinsco, I think it was called.
Zinsco.
Yeah.
We just replaced ours.
Yep.
Yeah, we didn't know. How
would you know? How would you?
How would we know?
Right. But there are insurance carriers now that are issuing policies. Yep. So your client buys a home, they insure through us, all looks good, everything looks great except for this panel. They do a post sale insurance inspection, right? Within 30 to 45 days. Oh, you have a Zinsco panel? 45 days from this date, we'll give you to replace that. Otherwise, we're off the risk.
Wow.
Because the Zinscos are considered to be dangerous.
Very dangerous, apparently.
So
yeah, we just replaced ours and it was a whole to do.
Yeah.
But PG&E kind of expedited it because they know the
understanding
risk.
What's going on.
They understand the risk. Yeah. And we remodeled and it was part of the deal. We're like, hey, we can't, like our contractor was like, hey, you can't do all this work and not replace this panel. Like it's not good.
Yeah.
You've got to replace it.
Yeah.
It's a real problem.
So those are small hiccups that are running into as well. So as a, that's one thing you want to look at from an insurance standpoint. Like,
got it.
Because literally if you flip up the panel, most of the time it'll have a sticker on there or some kind of label from when it was who produced it and you can tell, but that's another component. But that's scarier than the fire ones because Now all of a sudden it's like, I've already got insurance. I got my house. And now we're talking after the purchase, right? That they can come back and say, hey, we're no longer interested.
Wow. Okay. So like that's a big tip right there to take away, is like, let's look at this panel. Let's make sure.
Take 10 seconds, flip up the the lid
and understand what that means. And that might be something that you negotiate around. Like, this needs to be replaced, and this is what the cost is.
Right. Like, I'm going to have a harder time trying to get insurance because of this Zinsco panel. Like I was told, like, and again, it's a newer thing. So it's starting to catch traction, and more companies are starting to jump on board with this. It's something that, we ask the question, but like, we don't always get an answer. Oh, it's fine. It's a great circuit breaker box. It was replaced. And it's like, well, that doesn't really wait. You're going to be mad when find out that it's a Zinsco and you had to replace it.
Yeah.
So
got it.
Just another key component.
Okay. So, we have some clients that are buying in, County, Guerneville, Russian River area, and that's like a compounding insurance risk there. So talk to me about those types of properties and what types of things people need to be thinking about, what type of insurance they're going to need, and like relative costs compared to a standard neighborhood, newer built subdivision.
No, totally. So two things. I think it's important to understand that this State Farm now getting out, or not getting temporarily, they're not out altogether. They'll be back. But I know that I've spoken with farmers reps, and they're on like a 2-week hiatus where, you submit something. So you're having these options limited. So now all of a sudden you go to like Guerneville, okay, on the river, and you don't have, they have fire departments, but high density, there's a lot of wooded areas up there. Right. So there's very limited, almost no options for insurance companies up there. We're relegated to writing with the California Fair Plan.
So what's the California Fair Plan?
That's a great question. That's a loaded question. I'm going to give a really short answer because I've actually really nailed this. So California Fair Plan is this, simply stated. It is a fire only policy. Okay. And people go, well, what kind of fire? A kitchen fire, wildfire, anything that starts a fire. That's it. It does not provide liability. It does not provide plumbing, nothing, water leaks, nothing. It's fire only. Okay. That's all they're insuring for. And it's an a la carte type policy where you can kind of pick and choose what you want to go on there and how much. So that's period. That's it. Okay. There's nothing more to it.
Who provides it?
California Fair Plan. Okay, which is run out. They're out of LA, and it was the purpose of the California Fair Plan was to be like the last resort. So it's like if you had multiple claims, like you had 3 or 4 water claims, and you couldn't find insurance, or the condition of your house was so bad that nobody would take it. California Fair Plan took it, and they literally were like, we are your last resort. Now they're becoming the primary resort. So this system got overloaded real fast when these insurance companies started backing out due to fires, and they saw an influx in business like quickly. So what was fairly reasonable rates started jumping real fast because what do? You got a massive submission of policies.
Right. More properties, more risk. You
got to make sure you're still profitable.
Right.
So once you get the California Fair Plan one, that you're not done. You still have to get the difference in conditions policy. And people go, what? And the difference in conditions policy is basically a homeowner's policy minus, it literally is like a homeowner's policy minus the fire component. Okay.
So it's everything else.
Your water. Yeah.
Right.
Literally, if you wrote a standard homeowner's policy and took out fire, that's cool. It's the difference in conditions.
Someone's doing work on your house, they trip and fall, they get hurt.
Yep.
It covers your liability.
Your dishwasher leaks. Yeah. You're covered. Yes, exactly.
Something gets stolen off your property, cover that.
Correct.
Right.
Yep. So you now have to get the 2 of those. And, we've seen rates all over the board. I mean, again, you're talking about the further you get away from something in terms of a fire department or a fire hydrant, the more that's going to cost,
Yeah. Funny story about the fire hydrant thing. I have clients who bought up in like the foothills. Yeah. And there's a fire hydrant and their insurance provider was like, hey, it's more than 1,000. This is a few years ago. Yeah. More than 1,000 feet away.
Yeah.
And they're like, no, it's not. And so they like wound up going to like a tape measure to show them how far it was because it was a huge difference in cost.
Yeah.
Having it 1,100 feet or 900 feet was a massive difference monthly. And
now that component, unfortunately, is really not considered as much. It's not, it doesn't carry the weight that it used to. So it is what it is. I mean, I get it. They're trying to maintain profitability.
Yeah. I mean, it makes sense. And trying to diversify the risk and understanding like, hey, if we're just fire only, right, then we can have actuarial tables around like what is the likelihood of a catastrophic fire in this area, how many policies we have, and what that would cost, and how many other payers are paying in the pool, and how that overall
the reinsurance and all that. Yeah. I mean, we're going as far as to, and you're familiar with this area, and I know that everybody on this listening may not understand. Sure. We actually had an insurance company. So Petaluma, as you know, is divided into 2 zip codes, 94954, 94952. It's almost split right down the middle by the freeway.
Right.
So we have an insurance company that has, well, I don't know, we probably have 60, 70 policies with this particular company, and they're on the east side of Petaluma, and they are non-renewing the east side of Petaluma because the east side of Petaluma to them is considered to be a fire hazard area.
East side of Petaluma is considered to be a fire.
So Meadow School, the 3 houses over by Meadow School.
Yeah.
Non-renewed fire hazard.
That's really interesting.
I mean, you know exactly where that is.
I grew up in that neighborhood.
Exactly.
I know exactly where that is. So that's super interesting because it's like that. The west side actually seems like more of a fire
eucalyptus trees, the redwoods, all this,
and just kind of the like how some of those lots have developed where there's like grassy, wooded areas and like in the neighborhood.
And we're not talking, these houses we're talking about are
in older infrastructure, right?
These houses we're talking about are in suburbs, like divisions. Like they're not. It's not like they're one-offs, and that's like, oh, you had to go out, 3 miles down this country road.
Sure.
So it's just, again, we're in these unprecedented times, and it's wild because like I was just talking to Aaliyah, and I was like, 2 months ago, I was like, I told the office, I was like, I think we're at our worst right now. We're starting to see a little bit of light. And then, here State Farm drops this bomb. Now that doesn't affect us, but that's just a bomb in our industry.
Well, it changes because, changes the competition. Less people, that probably makes other insurers go, hey, if the biggest one out there is saying no more, why?
Yeah.
And maybe we need to rethink our pricing or our policies or our availability. And so we'll see other people drop out. We're seeing the same thing on the lending side where some of the large, like jumbo lenders, specialty lenders are saying, hey, we're either exiting the business or we're going to take a little break or we're going to change our policies so we don't have that many loans being made. And some people are being more aggressive and getting into the space and filling that gap, but others are saying, how come they're doing that?
Right.
If Wells is backing out, what do we need to be thinking?
What do they know that we don't know?
Exactly. And so it's kind of putting a pause on some things and changing some of the dynamics. So
here's something I was talking to somebody the other day, and I said, I think it was a real estate agent. I said, here's what you need to do. Just advise your client. It's simple math. Okay. Take the square footage of your house and times it by no less than 450 foot. Okay. That should be about approximately, give or take, could be a little bit less, could be a little bit more, about what you should be writing your home insurance for. Okay.
Okay. So a lot of people are underinsured.
Yeah. So here's what I'm getting at is that now when you have less competition, okay, with less markets, all right. And I'm not saying anybody in particular, I'm not directing this next comment at anybody, but when there's less competition, there are people that I don't want to call them crooked. Maybe they don't have the same practices that most people share. They're going to do whatever they can to write something and say, oh, this will work. Here you go, right here. And it's like, that's not enough insurance. Oh yeah, it is. It's no problem. So it's what the system told me that it was okay. It's approved. The system told me it was okay. It's fine. But as a home buyer, right? All of a sudden now you're like, okay, well, he said it was fine. I trusted him. He's a professional, but maybe it's $100,000 underneath where you should be.
Meaning if you do have a catastrophic loss, there's not enough insurance there to actually like rebuild the house.
Correct. Right. Which let me give you an example. Coffee Park, right? In Santa Rosa, that whole subdivision that burned very randomly, if you will. There were a lot of people that we learned, and even in Fountain Grove too, that were with a particular insurance company, right? They'd been with them for 25, 30 years and they were proud of it. Loyalty. I've been with them. They're giving me a great discount because I've been with them for so long. And there's no particular company I'm talking about. But what ends up happening is that they bought their house in the 80s, early 90s, right? And the inflation of the policy never caught up with the actual inflation in costs of rebuild and labor. So it's going up 2 or 3% per year coverage on their policy. But let's say the rates on labor and materials going up 5%. There's a 3% difference. You times that by 25. Yeah. So all of a sudden now they go to rebuild and they're going, I'm $200,000 short to rebuild my house. How's that possible? I've never had a claim. I've paid my time, and it's like you feel shorted. You feel like that's not necessarily the insurance company. That's more the agent's responsibility. So like we try to educate people and say, look, what's your square footage? Boom, let's times it by 425, 450 a square foot at least. Right,
and depending on the type of home, right? If you have like a
custom
luxury
house,
like you want to be
700-800,
right? You want to be replacing that, like for like.
Why save $200 a year to end up potentially having to spend $200 or $1,000 more or greater in a loss, right? Because you're short on insurance. Like it's just not, it's just a very approximate number.
Yeah.
But that happens. That's happened. And that's not where you want to be. Like you pay for insurance all the time. Like you don't want to all of a sudden get to the point where you need it. And it's like, it's not even providing me what I need.
So is the advice when you're getting the home, make sure that you have an agent who's looking out to say like, hey, let me explain to you how this works.
Yeah.
You're going to buy this house. If there's a catastrophic loss, you're covered up to $450 a square foot to rebuild it, right? Like and that's going to cost you X. Now, you might be quoted by some online person or whatever that's going to spit out, the technical replacement cost of $225 a foot or whatever. But it means you're like $200 a foot short on a 2,000 square foot house.
Just
like,
$500,000 in coverage.
Right?
Ish.
So yes, is it less to go with them? Absolutely. But do you have the same coverage? No. And do you want to be underinsured for a difference of $28 a month? Probably not. Right? So, and then also over time to have your policy looked at ongoing, not just set it and forget it and just as long as I keep paying, it's going to be fine. Like making me think here, like if you just did a big renovation on your home or you just did something, changed something up, like maybe you went from maybe $300 a foot was right at a certain point, but now
not anymore. I mean, you go like you have people down in like we've had some people in Fresno, right? Material and labor might be a little bit less down there than it is in the Bay Area. Bay Area is obviously one of the higher, if not one of the most expensive places to live in California. Right. So they're going, why am I'm paying X, but you're insuring it for this? And people have to understand you're not insuring it for the value that it is right now. You're insuring for replacement cost. So the actual value of the home might be less than what you're insuring it for. So the value of the home might be $200,000, but you're insuring it for $300,000 because the $300,000 is what it would cost to rebuild right now.
Right.
Okay. There's a common misconception there. And they miss it and go, why, Chad, you're giving me, this is too much insurance. Like it's only worth $200,000. I go, no, I know that. But imagine if it burned down, you had to rebuild. Like you're not building it for $200,000.
Right.
People go, oh, that makes sense.
Well, and we learned in the recent fires in Sonoma County is if one house is lost and a whole neighborhood is lost, cost goes up to rebuild it, right? It's not $300 a foot because there's competition for labor and resources. And if you want to rebuild your house within a timely fashion, it's going to be more than you're thinking. Right?
Absolutely.
So I think the takeaway I'm getting here, like targeting the message back to someone who's buying a house, current homeowners, don't just take insurance to check the box. Hey, my lender's requiring that I'm getting homeowners insurance. What's the cheapest policy I can get? Right? Like we have that conversation sometimes. And it's like, is the likelihood that you actually have to use your insurance, it's probably pretty low, right? But if you do have to use it, you're going to want proper coverage and proper insurance. And let's not overlook, the importance of having that in place.
Absolutely. There's ways to offset costs.
Okay. Tell me about
higher deductible.
Okay.
Right. A lot of people go with a $500, $1,000 deductible. It's like, you're not filing a claim. That's fine because you don't want that on your insurance.
Right.
Go to $2,500, go to $5,000. Get more coverage.
Meaning if I have a claim, my dishwasher leaks and I've got to replace stuff, if the cost to do that is under $5,000 to fix it, replace it, I would pay that. I'd rather just pay that out of pocket directly and not make an insurance claim.
Correct.
Okay.
Yep. Like save your claims for like more bigger items, right? Your dishwasher leaks, your flooring, your hardwood flooring, you're $20,000, right? File a claim. Absolutely. But, it's like, oh, my dishwasher broke and it flooded the laundry room and it's, 50 square feet of hardwood flooring. Like just replace that.
Right.
Don't file that claim because all of a sudden now it's check mark, right? That's one on the docket.
And next time you renew, it's going to be more expensive.
You're going to get an increase. Right. And then when you have that big one that you have to file, now you got two on there, right? And two, water claims specifically are, it's a kiss of death. Two claims can be tough, but two water claims, like forget about it. Like you want to see people run, like they'll run real fast when they see you coming.
Man.
So there's just, like I say, there's ways to kind of protect yourself. So by going with higher deductibles, like a lot of times people will look at claims a lot differently. Oh, like I'll just fix it, or they'll call us and say, hey, I got this scenario. What do you think I should do? And I said, fix it. Right. Do not file a claim. Do not call the insurance company right now, because that's the first thing they do. I got water on the floor, and they call the insurance company, and that starts a claim. Even if you don't get a payout, even if you don't reach your deductible, that shows as an incident. It's not a claim, but it's an incident. So it shows a history now.
Man. So if you way more detailed. Okay. So,
no, totally. So let me play a scenario out, right? So your kitchen, you have a leak in the kitchen, and you're like, oh my God, I got to call my insurance company. So you pick up the phone and call insurance company, whatever. And you haven't assessed really what the damage is. It could be $1,000. It could be just like, hey, I got to stop this. I got to replace some boards, maybe a little bit of carpet, whatever it may be. Okay. $1,000, $1,500. You call, you file the claim, and they go, I'm sorry, ma'am, or sir, like you have not reached your deductible, which is $2,500. So you're going to have to fix that on your own. Like, oh, okay. Dang. Thought I might get that one right there. Well, check. That now creates history. So then when you have another claim, a year later, they're going to go, there's another claim. And they might look and they go, there's too much history there showing water. Like, we're going to non-renew your policy. We're going to get off that risk. Well, now you start to go to other companies, and they pull what's called a CLUE report, which is a comprehensive loss under, I forgot what the UE it means. And they will pull up a history of anything that's been reported. And they go, oh, sorry, Dan.
Even if it was a different company.
We had a client. Yep.
It's like a credit report for your
pretty much
insurance claim.
We had a client. This is all relative. I know these numbers sound real big. San Diego, great house, awesome. Before he was a client of ours, he had filed 2 water claims that he did not collect on. Decided to either not fix it or fix it himself, whatever. But they showed a history, all right?
Wow.
And he was paying, for the sake of the argument, he was paying $15,000 a year for home insurance. Big, nice house. So it wasn't, that's fine. We get the non-renewal. Okay. So we start shopping it out to all our markets, and we're getting no declines. We start moving out further and further to the point where his $15,000, now mind you, he got $0. Okay. And then when he tried to go back and get the money because he found out how much he was going to have to pay, he was outside of statute of limitations of 2 years. So he goes to get his next quote. It was $39,000. That was the next best option. And I'm telling you, we have a pretty far reach when it comes to that. And they were like, nope, it was just 2 water claims. And I'm like, he didn't even get a payout. And it's like, doesn't matter. There was 2 incidents. So it's just something to consider about when you're, so we advise, and I advise anybody else, call your insurance agent before you call the insurance company.
Right.
Here's what I've got.
Yeah, call your local agent, and I think
pick their brain.
Having them on the team, right? Like accessible can get to you. And if you've got like, hey, I got this is what happened. What should I do? Right.
Walk me through my options.
Start that phone call.
Walk me through my options.
Right.
Yep. And then we play the pros and cons. It's like, oh, you have about $5,000 in damage. Like, it's like, because here's a catch. On a claim, people go, well, I'm going to have to pay $5,000. No, you're going to be less out the deductible. So if it's a $10,000 claim and you have a $1,000 deductible, the insurance company is going to pay you $9. They're not going to make you pay them. They're going to pay you $9. So it's just important to understand, like, if you want, a lot of times what we'll do is we'll take somebody and say they're paying $1,000 a year for insurance and they're underinsured. We'll get them up to where they need to be, and then we'll increase the deductible to $2,500, and it offsets that increase. So you're getting more coverage. You're not really changing much other than the fact of what you would have to pay in a claim. And how many people have home claims? Like, how long have you been a homeowner? 10, 15 years? Like, how many claims have you had?
None.
I've had 1 in 11 years.
Right.
So it's,
not something that you use often, but
you're playing the odds. Yeah. Play the odds.
So focus back on the home buyer question.
Yep.
And, obviously people are like shopping for homeowners insurance. They're calling multiple people, multiple agents, multiple companies. They're, looking at people online, doing whatever they're doing. What's your advice for someone who might have multiple estimates or multiple quotes in front of them? How do they pick the right one? What's your advice?
Coverage. I think you have to, go back to that algorithm I told you. Square footage times 450. What are if they're all apples to apples, let's just say for the sake of the argument, they're all the same coverage. If we're going with that argument, I think you need to pick who you feel most comfortable with. Service. What kind of service are you going to get? Like when you pick up the phone, is somebody going to answer? You write an email about a question or your coverage. Are they going to get back to you?
Right.
Like those are the types of things, because people panic.
Do you think the home buyer should be the one saying, hey, I'm going to buy this house at 123 Main Street, whatever it is, and I'd like to see a quote with replacement cost of $450 a square foot and a $2,500 deductible. Like, send me that quote. Yeah. Is that
That'd be awesome.
How should they be approached? Like, what's the advice? That's the advice is
I would be, if somebody called me and said that, I'd be like, they've done their homework, right? They know what they want, right? Because they're spitting out things that normally wouldn't be. I'd be like, okay, because normally when somebody calls, they're like, I'm in escrow, I'm in contract.
What do I need?
They told me to call you. Right. So now you're kind of giving me the option. Now our office will do fine, but and there are other people out there, other agents that they'll be like, oh, they've given me the opportunity. Like I'm going to do, I'm going to get them the best price possible. It's not always about price. You have clients that sometimes will go and say, like, hey, I'm going to work with Dan because I know what I'm going to get. Like I'm getting Dan. Right. So whatever that looks like for them, that's why they're coming through you. Right. Same thing. People come through us and they might pay higher rates and more on their insurance. Admittedly, they know that. But they want the service, right? That's what they're looking for. Right. When I have an issue, can I call? Yeah,
within a margin, right? Like if it's crazy difference between like coverage being the same.
Yes.
Right? Like for us, like rate has to be pretty close. It can't be.
Absolutely.
If all else being equal, someone else is quoting 6.5 and I'm at 8, like that's not going to work, right? But if I'm like pretty close to that and I'm going to say, hey, yes, could you use the online guy and get it 6.5? It's slightly more to be with me, but you're going to have me and my team, and you're going to get a hold of me, and I'm going to service your like we're going to like there's benefits beyond the cost that they're getting, right?
Totally.
But if the advice is if you're home shopping or home buying right now, to go call multiple people, call multiple insurance providers, right? Doing the homework and say, this is what I want. $450 a square foot. It's 2,000 square feet, $2,500 deductible. Let's start with that price. What is that going to cost?
Yeah. That'd be a really good baseline.
And then compare based off of that, apples to apples.
Yeah. It's a really good baseline. I mean, that's very simple.
So who gets back to you? Like maybe some of the criteria. I'm going to call 3 people, ask them for this exact same quote. Number one, who gets back to me? Who picks the phone? Who do I have to call multiple times to get this information from them?
Yeah.
Right. What's the price and what's the overall experience? And then like weighing out all of those things together before and making the choice from there.
Yeah.
Is that how you would like?
Yeah. And here's the thing. Ultimately, like go with your gut too. Like trust your gut, right? We all make purchases. We all do things with people that do services. Like, when you renovate your house and you pick a contractor or something like that. Guy might come in super low price. You're like, man, it sounds really competitive, right? But I had a really good experience, and I seem to be on the same page with this guy, even though he's a little bit higher. Like my gut says, go with the higher guy.
Right.
So yes, after weighing all that, like go with your gut too. Like what does it tell you? Like who is that? Did you have a good vibe with that person? Because you're probably going to work with this person either for a long period of time, very little, or a short period of time, a lot. If you have a claim, like that's when they become. Like you don't really know how good of an insurance agent you have. And I'm speaking on insurance because I can't speak outside that.
Sure.
Until you have a claim.
It's a good point. But a leading indicator might be the responsiveness, the communication, like just the professionalism overall. Yeah. And just like double checking, like congratulating them when they close on their house.
Yeah, but imagine if you got an email like this. Like you sent out to insurance company A and there's B. So A comes back to you and says, hey Dan, quote attached. And you're like, cool. And then company B comes back. Hey Dan, congrats on it. Would love to really try and write this business with you. Here, I threw in a couple of things right here. I want you to make focus on just to see it's a forfeit. It's like, oh, cool. I kind of got an understanding. I kind of see where I'm going to go with this relationship if I choose to go that route. That says a lot.
Yeah.
Nobody likes just here, read this. Like I came to you. Yeah. I wanted to get an explanation.
Yeah. In our business, it's similar. Here are some options.
Yeah.
Take some time to review this, and then let's get on a phone call together and let's look at them together. Because there's some things I want to point out to you. But I know that we're busy and you want the information. I don't want to not give you the information, right? So I'm going to respond to you almost immediately. But then let's set up a time where we can really focus and look at this together and let's see what the different options are. Let's see why we might go, a rate buy down as opposed to not and a temporary as opposed to a permanent buy down. Let's look at those details together. It's too much for me to explain in one email, but here's all the info for you to synthesize.
Right.
It's kind of the same thing. This is how I would insure it if it were me, but I'm not, I'm not going buying it. Let's look at some options and make a decision together.
Well, that's the thing. I mean, I tell our office all the time, and you're in the similar industry, is like, we're not here to tell them what to do. We're here to provide what they need and give them options and then help them based on what they want, get to their end goal. Like, do you want to pay $2,500 deductible out of pocket? No. I have people say, I do not want to do that. I want $1,000. Okay, great. That was your option. You chose that option. Okay. We didn't force you into that. We didn't make you take that.
Yep.
We didn't make you take a $5,000. But if we go with the higher, it's, you explain, give them the option to choose that. Like they don't want to be forced into doing it. Nobody wants to do that. So that's how we kind of craft our quoting process or our for a home buyer, because it's daunting. It's a lot going on. They're in escrow and there are a lot of money being pushed around and you're talking big numbers. And then you got this insurance component. You're like, I don't even know what this means. And I don't have anybody like this.
Well, they're like fatigued at a certain point because they're worried about, do we like the house? How's it going to function for us? And then, got to look in all these inspections and look at this and look at that and all these disclosures. And this is all the stuff that we have to know. And the loan information, the loan deals, insurance too. Like that's a lot to take on. And you get decision fatigue and they're like, just tell me what I need to do.
Yeah.
Right. Yeah. And it's almost like the worst case scenario. Tell me cause you don't want to underinsure them, but you also want them to understand the value that they're getting.
100%. Yeah.
And what they're really riding around. Like I think back, like, have I really ever had an experience actually looking at the policy? Like this is what you're actually buying every single month when you buy this policy.
Yeah, no, there's a lot of bells and whistles. There's a lot of things within that policy that you're like, what is this stuff? And a lot of it's just like, it's throw in.
Right.
Okay. And some of it applies, some of it doesn't. Some are lower limits that may not even apply had you, if you had something. And there's about 4 or 5 things on there that we highlight.
Okay.
The rest of the stuff is kind of like all comparable, and it's like little things here and there, like, fire department service. Like if you had to come out there and something, they had to it has to do with water. I think the fire hydrant or something like that. I honestly, I don't even know what the coverage totally means.
Okay.
But it's on there and it gives you $500 for it, right?
Okay.
So
what are the 4 or 5 things that you're pointing out?
So the big thing would be like, obviously the coverage on the house. Okay.
The total dollar amount covered.
Total dollar amount coverage. Okay. There's a second component. There's kind of a caveat to that part B, and that's to make sure that you have the extended dwelling replacement cost. What does that mean? Okay. So it's easier to give an example. So let's just say that you're insured for $1 million. Okay. It's the minimum the insurance company is going to pay out in a loss. It won't pay a penny less. Okay. But that doesn't mean that you may have enough insurance. So you get what's called, and from what I've seen, almost every single agent writes this.
Okay.
There are options for 125 and 150% above and beyond that million. So let me play out the example. If you have the extended dwelling replacement cost, it works like this. Your house burns down. You have $1 million in coverage. Contractor comes out and says, Dan, it's going to cost you 1.2. And you're going to go, I have $1 million on my policy. But then you look at your policy and you go, oh, I have this extended dwelling replacement cost, which means I have 150% of that 1 million if needed. It's your margin. Okay.
Got it.
So really you have 1.5. Because you're getting up to 1.5 total insurance value.
But if I only spend 1.2, they don't give me another $300,000.
No, they're not going to do that.
Got it. That's
only really if you have a spike in, we're supposed to do our job and write it at an appropriate amount. But if there is a spike in, material or labor, whatever it may be, that's why that extended is in there, to create that margin. Sometimes I've seen insurance agents where they'll take that, they'll take their 450 we talk about and they'll go down to 250. Build that 50% in and then get to 450 using the both of them, but it creates no margin.
Right. There's no margin for error. That is.
No, if something happened, catastrophic, it's highly unlikely, but the point being, it's just like, we don't play around with it. It's just not that much money to. So
overall insured value,
the extended liability. We're in California, like max out there.
What does that mean? Okay.
So you're hosting people at your house, right? And you're doing a little bit of construction. And let's just say that the step out to the backyard, whatever, was kind of like, it's a little wonky, or you're about to fix it.
Sure.
So somebody trips and falls, they trip over the step, they, tear their ACL, right? And they're mad at you. Dan, you should have told me about that. Or you should have done, I should have been warned about that. And, they go and they sue you, right? They're going to sue you for $400,000, $500,000, $1 million, whatever it may be, because I have an injury, can't work, I've got pain and suffering, all these different things. It's like, that's what the liability will cover you for. So it provides for third-party liability within the house.
Okay.
If somebody gets hurt. Or
if I get hurt, though, it doesn't cover me.
No.
Right. Got it.
That's just called being clumsy. So the liability is other structures.
Okay.
Is one. It's a small component because, if you're living in the city, you might have your house and that's it. But let's just say you live on the outside of Petaluma, or you have a little bit of land.
Sure.
And you've got a barn or you've got a detached garage or something like that. You want to pay attention to that other structures coverage, because once it gets detached, it goes under that class, that other structures class.
Oh, interesting. I have a detached garage on our first house.
Yeah.
And I don't think I've ever looked at the insurance policy.
Typically, if you're insured, again, going back to the $1 million insurance, your 10% is going to be on another structure. So you're going to have 100,000. A detached garage, 100,000 should be fine. But what if you had like an
ADU above it or something?
Yeah, or a prefab structure out back that was $100,000 and this detached garage. Right now you're underinsured. So those are some components. Loss of use, which is included on all policies. It's not really, but you should understand loss of use basically provides money if you're displaced due to a claim. So it gives you money for rent or a hotel.
Oh, interesting. I heard this. So during the big fires up here, people were using their loss of use coverage because they basically had, it's catastrophic loss of their home.
Mm-hmm.
And the insurance company was basically like years per day rental. Like you can go get a hotel room.
Yeah.
And these went on for multiple years.
Yeah.
And so they were, getting $300 or $400 a day for loss of use. And it was like they bought another house essentially and were paying the mortgage of that with their loss of use claim.
There's we've heard
pretty crazy stuff that people were doing.
No, totally. Yeah. But we've also heard people that whether it's true or not, that insurance companies were buying them, like buying fifth wheels. Right? Because all of a sudden I buy a $40,000 fifth wheel and I know that person's going to be displaced for 2 years at $5,000 a month, right? That's $60,000 in year one. Right. So whether it's true or not, it's fun to talk about.
Yeah.
But the loss of use, provides money for you to live elsewhere if you're displaced for an extended period of time. Well, at any point in time. I mean, we had a water leak in our first house and we were out for 3 days because they had to dry out the floors.
Right.
And we got money to go live in a hotel for 3 days.
Because it was one of those compounded. So you got the real claim was for the repair of the water leak,
mm-hmm.
right? And like mitigating all that stuff.
Yep.
In addition to that, you got some additional money to go for your living expenses while
Correct.
You're displaced. Yeah.
And food.
Yeah. Interesting. Any other advice that you have for home buyers, homeowners to make sure they've got the proper insurance? It's kind of beginning of summer, right? We're going to get into fire season here. Hopefully it's not a bad one. But what advice would you have for homeowners, home buyers when it comes to, properly insuring and making sure that they've done an audit and checkup on their policy?
I'm going to circle back to what we talked about initially, and that's being when you find a house that you like, find out about the insurance on it right away before you even make an offer. Understand what you're getting into. That's a big, because that will help with that emotional potential fallout, if you will. And then 2, just do the simple math. Like when you get a quote, be like, hey, my understanding is that it should be about $425-$450 a square foot minimum, for a standard house.
Sure.
I noticed yours is at $350. Why? Like, because we can all have a calculator. We can all go 2,000 times 400 is 800,000.
Right.
So that's something just to do a little bit of that in itself, the knowledge is the power right there. Because now you're kind of putting somebody on call and being like, why is it there? Like, help me understand that. Oh, well, it's this. And you'll find out, you get a BS answer. Well, then there's your gut feeling again. Like, how'd you feel when you got that explanation? Did it feel that was it justified? Oh, well, it's got this 150% here too. Well, that gets it up to, it's like, well, no, I think a good baseline would be 424, 450, that range. So honestly, I would start with those 2 things because you can't really go wrong, right? Because you're finding out what your overall risk is going to be if you get into that house. And you find out your biggest coverage is going to be covering the house if something happens.
Okay.
Obviously there's some other small things, but those are the 2 big components. And once you get those and you're comfortable with those, then there's some other things within there that you want to look at. But those are the 2 main things to start with.
And before you make a claim, call your agent.
Yes, that's a big one too. Yes.
Right.
Yeah. Call and talk about what the thing is. I mean, obviously if your house burns down, you don't need to call and discuss what are my options.
Yeah.
But if you have a water leak, it's like, hey, it was leaking underneath the sink and it rotted out my vanity and the floor looks a little bit wet. I think I'm going to file a claim. And it's like, no, don't do that. You have a $2,500 claim. That vanity is $1,000 or whatever it may be.
That's unfortunate.
Slow down.
Let's not mess up your insurance over it.
No.
Got it.
Yeah.
Cool.
So,
well, I'll make sure that people have your contact information in the show notes, and we'll put your office phone number, and people can come call you if they need a second opinion or whatever. And I appreciate everything you do for our clients that we refer to you. You do great customer service and you take care of them. And thanks for being on the show.
Awesome. Thank you. Thanks for having me.
Stay up to date with Bay Area real estate. Hit subscribe now if you haven't already. Did you enjoy this episode? We love reviews in the Apple Podcasts app. We'll read yours on the show. This is By the Bay.